So let's break it down real basic, because I think a lot of people think they understand banking until they start getting the nuances of it. And it gets a little bit more complex as you layer in the challenges, right? So banks primarily make money on net interest margin. The difference is between what they're making on the loans that they put out versus what they're giving you on your deposit rate. So if they're giving you 5% on your deposit rates, but they're making 7% on average in their loans, that 2% difference is their profit margin.
Mm-hmm. Wouldn't you multiply that by 9 because they can go 9 times the money that's in there though?
Right. When you start layering the idiosyncrasies, that's absolutely what happens. And a great example of that is, let's say I've got a loan to you on your home and it's $1 million loan.
Right.
I could then turn around and take that loan, that promissory note, and pledge it to the Federal Home Loan Bank of San Francisco for here. And they would give me, call it 50% of that value to now use and redeploy as capital. So now I've got $500,000 on that $1 million note that I can now redeploy as additional money and make more interest on that loan, which is already making interest.
And then it goes again.
And it can go again, and it go again, and it can go again. Now, there are regulations and limits to how many times you should be doing that, and they're usually done by leverage ratios and capital ratios that banks have to stay in compliance with. But it gets very, very murky. At its core, though, the difference between those two, though, deposit weighted average coupon, the rate, and loan weighted average coupon, the rate, is how banks make money. There's all other things like fee-based money, or like Silicon Valley Bank that we saw. They had venture capital stuff they were putting in that's really kind of hybridized stuff, or even private equity, which you guys know really well. They were putting money into those things because they would hope to get big, big returns. Well, when the tech sector takes a dive and they don't get those big, big returns, and their primary income stream is now strained, things can change pretty quickly. So yeah, the sector can be very, very complex, and things can get very, very out of hand very quickly because of the leverage that's allowed. But that's how capitalism works, right? The banking structure is built so that banks put out money so people have more access to cash to run their businesses, to leverage up, to have working capital for lines of credit, to buy homes. And now when you start doing things like quantitative tightening and pulling that out of the markets, people are calling this a credit tightening cycle. It's not, though. Not yet. Right now, we're just seeing banks say, okay, if I put out money today, and the Fed is in an interest rate increasing cycle, I'm going to lose money because that rate could be 25 basis points or 50 basis points higher if I just wait.
Right.
Right? Mm-hmm. At the same time, they're saying, okay, and we also don't know what's happening in the economy. Is there a recession looming? Are these credits we're making now, these loans, going to go bad? Do we wait? So banks right now are just holding back.
A lot of uncertainty.
A lot of uncertainty. So it's not a credit tightening cycle yet, what you're seeing in the news. What you're seeing is banks are pulling back, saying, I'm going to wait to put this money out because every dollar I put out when the Fed's done raising rates is going to be worth more than a dollar I put out now.
So what's the different? What will a tightening cycle look like? What will be different about that than what we're experiencing right now? Well, what will, as a consumer, what will I see different?
Yeah, access to money in the markets will become very difficult to come by. So the first part of it we're already seeing, right? Businesses that have been run for the last 14 years in a very artificially low interest rate environment now have index plus margin pricing. So their loans are based on an index plus a margin, and that changes as interest rates rise. And the Fed has increased rates at an unprecedented cadence. They've never done it at this cadence, at least not that I can recall. And certainly we haven't.
What about during Reagan's? They raised rates quite a bit there to crush.
They
inflation.
did, but I don't think it was in a year though. I think it was a little bit longer.
Yeah,
period of time.
not this many in a row, and this short of a period of time.
Sure. And that's actually the biggest problem what we're seeing now. So the Fed, going back to regulation, right? They have a severe adverse case scenario of how banks are supposed to stress test their balance sheets, right? And basically what it says is if rates go up, and I think their Fed severe adverse case scenario is 4%. If interest rates rise 4% in any given year, will your bank still be, quote, well capitalized?
Okay.
Except the Fed increased rates in a single year 5%.
Oh, so beyond the stress test that they even use.
Beyond their own severe adverse case scenario. And even in their own baseline scenario and some of the things that they thought were going to happen, they were way off. And okay, we were all way off on our predictions. Moody's, everybody who's predicting numbers. I mean, economists all over the country were wrong. That's fine. I mean, nobody plans for recession. Nobody plans for big changes. But the fact of the matter is the Fed didn't have to increase rates at the cadence they did. They could have done it over a year and a half, like in Reagan's generation.
Wow.
They chose to do it in this truncated period. And I think there's a little bit of stigma and pressure on them because the general consensus is the Fed acted a year too late.